Check.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning and welcome back from a long Easter vacation weekend, right? So 3-day weekend, markets were closed on Friday, so we're back in the action today. A little bit weak out of the gate this morning, concerns over a variety of things. Also, over the weekend, unfortunately, Pope Francis passed away. So that was, kind of a big thing. Outside of that, concerns over Trump, tariffs, ongoing economic debacles, recessions, those are all the big concerns this morning. Again, markets just kind of trading in a big range right now, recovering a bit from those recent lows, but we'll get into that this morning because we're going to talk a little bit about the 200-day, 50-200-day crossover. We touched on this on Thursday of last week, talking about the death cross. Wrote an article on it. It's posted on the website today. The history of the death crosses. What does that mean historically for markets? And put something that we actually talked about on Saturday with Adam Taggart on the YouTube channel, which is that the market's very likely making a low in here somewhere. Are we at the low, the final low? Probably not. But we're probably in that process. Again, extremely negative sentiment, those offsides positioning, that all kind of leads into that. Talked about that with Adam this weekend. But again, there's a bit of more work to do here in markets. We still have to navigate through this whole tariff issue. That's going to keep giving us these bouts of volatility. And now, of course, the big kind of headline for the markets right now is over the Trump and Powell feud that is now back. We had this same fight back in 2018, and Trump was talking about why the Fed needed to cut rates, and the Fed was like, no, we're not going to cut rates here for whatever reasons. And then a few months later, the Fed was cutting rates because we were on the verge of an economic recession, and basically because we were having a massive repo crisis at the time, and the Fed was having to cut rates back towards zero to solve that problem. So, here we are once again in that same type of turmoil. The Fed cut rates in September of last year by 50 basis points when the economy was growing at over 3%, and there was no risk economically. We talked about the fact, why are you cutting rates here? This isn't when you cut rates. Not with economic growth at 3% and you're running, below 4% employment. Why are you cutting rates here? Then they cut rates 2 more times after that. Didn't really make a lot of sense. Now, with the economy running at basically zero in the first quarter and unemployment starting to rise here a bit and starting to see more concern about CEO confidence deteriorating, which typically leads to employment, rises in unemployment, the Fed should be cutting rates here. This is when you start cutting rates, not last year. But again, we've got this whole big political feud right now between the White House and the Federal Reserve. That's weighing on markets today. The White House can't fire the Fed, not without cause. So, they are nominated by the Fed chair is nominated by the president. He is appointed through the same process that he nominates other people for Secretary of State or whatever. They've got to go through the nomination process. Then they get installed into office, but they cannot be removed until their term is up unless there's cause, and there's not any cause right now. So this whole kind of debate in the media and everything else is kind of ridiculous. The Trump's trying to explore other ways to get rid of Jerome Powell, maybe try to force him to quit. I don't know, but there's not really much that Trump can do at this point in terms of the Fed. So, but again, the markets are looking for a reason to rationalize kind of what's going on in the markets. And all that's going on in the markets right now is that we're just working off an overbought condition that existed. We came into this year after 20% up years in the markets, and we're having a correction. That's all that's going on, right? We can try to assign all these rationalizations to it and everything else. It's this, it's that, it's the other thing. No, the economy's slowing down. Earnings expectations need to come down. They haven't yet. In fact, I just looked at S&P's earnings estimates for 2026 yesterday, and they've actually raised them for 2026. Went from 283 to 290. So again, the optimism for earnings going forward, for earnings growth, this economic turmoil we're going through right now is expected to be fairly short-lived, and then we're going to be kind of back into growth mode after that. We'll see what happens, but this is one of the things that's going on. But it's important to separate out trying to rationalize when things are happening, trying to assign why is the market down today? Well, it's because of the fight between Trump and no, it's just we're still working through a correctional process in the markets. We have this death cross that we'll talk about this morning, and that's putting pressure on markets. In fact, let's just go ahead and talk about that. Here's what you need to know before the bell this morning. Markets are going to be under pressure at the open. Dow's down about 140 points right now. The S&P is going to be down about 50. So we'll see how things open up this morning. Again, kind of pre-market, especially after a long holiday, tends to be a little bit volatile, and we'll kind of see as traders return to the markets this morning how markets respond. We'll see if some buying comes in today. But again, we're just simply working through. We've had this correction. We've had that reflexive rally. Back at the peak of this reflexive rally, we talked about reducing some risk, taking some money off the table. We added, we raised some cash levels in portfolios. We added a bit of a short position. So markets are just kind of working through this. It wouldn't be surprising to see this market drift back down here a bit, try to ultimately retest these lows or maybe even set a higher lows we've talked about before. That would certainly be very normal because you have this downward pressure in the market. The market has been wrestling with this 20-day moving average for the last few weeks, and that's really kind of been the confinement of what's going on in the market currently. Is as this 20-day moving average comes down, we keep testing it, failing it, testing it, failing it, and we're going to do that a few more times here before we ultimately kind of set a bottom for the markets. But we're getting there. Markets are still, not deeply oversold here. So again, that's why we're getting a little bit of pressure on the markets right now. But again, as we work through this process, we'll start to see better performance, some stabilization, and that's going to be a better indicator of when to really start becoming a little bit more aggressive in buying equities. That's not now. That's probably going to be sometime September, October. We'll probably find a bottom in the market sometime this summer. Late summer, we'll start kind of seeing some money flows coming back into the markets, and then we'll start, probably around October, November, start talking about, better outlooks for markets at that point. Estimates should have come down. We should have worked through a lot of these other issues, whether it's tariffs or trade or Powell. That should all be behind us at that point, and then markets can start kind of looking forward. Another kind of interesting thing going on right now is Bitcoin, which has been, kind of stuck here for a while. It's been on a bit of a buy signal, but it triggered a buy signal here recently. It is getting a little bit overbought here short term, but we're starting to see a little bit of a push up. We've gotten above the 50, heading back to the 200-day moving average, which right now you have a death cross there as well. But again, this is part of what we'll talk about this morning. These death crosses tend to kind of mark lows in markets, not necessarily the beginning of bigger corrections. But again, if Bitcoin can get kind of above the 200-day moving average, you're going to start potentially kind of seeing that bid a little bit more as we start to see money flows kind of start to chase performance. Because again, right now, all that happens in the markets is that if one asset class is declining, money will come out of that asset to go chase another asset. When that asset gets extremely overbought, that becomes a source of liquidity and then moves back into the asset class that's super oversold. Again, we kind of saw that earlier this year. Markets were extremely overbought. They've been providing a source of liquidity, stocks getting sold off to go buy gold, go buy whatever, right? And so eventually that is going to reverse once we get into that next phase of the markets, but that won't be really until later this year. The dollar also under pressure right now. That's certainly putting a lot of downward issues, concerns right now as well. But again, important to keep this very much in context. Dollar is extremely oversold here. Again, so probably start to look for a bounce in the dollar here sometime soon. Nothing major, but probably somewhere between 100 and 102. Get a bounce here back in the dollar. That'll help alleviate some of the pressure on the markets themselves if that begins to occur. So again, kind of watch the dollar. It's kind of a key to a lot of the stuff that's going on in the market. So, but expect a reversal rally in the dollar just because it's very, very oversold here. So you're going to get some reflexive activity in it as well. Okay, that's what you need to know before the bell this morning. We'll come back. We'll talk about the death cross, the 200-day moving average, and the art of contrarianism, all coming up on the show this morning. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So a couple of things to talk about. First of all, I want to talk about this weekend's newsletter because, this is the point in markets where we start making a lot of emotional mistakes. We start looking for, reasons and rationalizations and those type of things. And again, I get tons of emails from people from, YouTube and everything else. People send me emails. Well, what about this? And what about this? And what about, what's happening over here and what's happening with this? And this is where, people start making mistakes. And, I got, emails about people have taken on a lot of leverage and that's worked against them here recently. And that's not surprising as well. But, kind of what we talked about in this weekend's newsletter is that what we're going through right now is a corrective period, right? This shouldn't be surprising. Markets had 20% return years right back to back. They've had a great run, really, since 2009, up 600%, whatever. So again, you're going to have these corrections from time to time, and that should be part of the process of just investing. You should be aware of that, and that, hey, if I'm, the price I pay to invest is volatility. That's just kind of the nature of things. And it doesn't matter what the asset is. There's, stocks, bonds, crypto, gold. They're all subject to the same environments. And in some cases, they do very, very well for a period of time. And then they have a period of time where they don't do well. Again, for every asset class, reversions to the mean exist for every asset class. That never changes. The trick about investing is to be able to buy things when nobody else wants to buy them, right? And that's the contrarian investing part, to sell stuff when everybody wants to buy it, right? And that's kind of like, for instance, a lot of debate about gold here recently because gold's going up, is doing great. It'll be up again today over concerns about, this Powell Fed chairman thing. But that's not really why, it's not, gold's not going up because it's the Fed concern over Trump or the deficits or anything. That's not why gold's going up. Gold's going up because people are buying it, right? What drives the prices of anything is buyers and sellers. and you have more buyers, then you have people willing to sell, and people that are wanting that you can convince to sell their gold right now, you've got to pay a higher price for it. So that's just been the case lately. That will eventually change. And that asset that everybody's piling into, when it begins to reverse, people will start selling that. That will become a source of liquidity for some other asset class that's beginning to rise from a low. And people say, oh, look, look what stocks are doing now. They're starting to come back from this recent correction process. And that's what's been going on lately is I'm selling stocks and buying gold. So stocks are a source of liquidity, so I can buy gold. I got to sell something. Money doesn't, and the important thing to understand about markets is that money is like energy. It's not, you can't destroy energy. It just changes form. And that's all that happens in the financial markets is that we take money and we change its form. For the last 2 years, everybody was buying stocks. Now, but if I want to buy gold now because gold's going up, I've got to sell my stocks to buy gold, right? So money in the markets just change form. We're not creating a lot of new money. We're not doing, we're saving, sure, we're earning some money, we're saving, and that money's coming into the markets. But predominantly, most of the money there is just shifting form of what it's in. And that's just how markets work over time. And eventually, what everybody was chasing, that will decline and it'll become a source of liquidity to buy whatever's next. That is going to be the case. And so that's why it's important. And this is why, the art of contrarianism is so important, because these are the times where you're looking at stocks as an example and saying, look, man, stocks are just getting beat up. Just get me out of stocks. I don't want to be in stocks right now. Hey, I get it, right? It's emotionally exhausting right now in the stock market. But this is where opportunities are formed. Stocks are trading a lot cheaper on a lot of fronts. This is where you'll have an opportunity to buy companies at a much cheaper base. And at some point, that's where your reward will come from. But in order to do that, you're going to have to sell another asset, right? So this is why, this is why at the end of the day, we always go back and we look at technicals, because technicals tell us, kind of where we are within this picture. And it doesn't mean that things immediately change today at all. Doesn't mean things are going to change next month. Doesn't mean things are going to change this year, right? When things have a lot of momentum in the markets, either up or down, we have negative momentum in the stock market. We have positive momentum in the gold market. That can last a very long time because of psychology. But this is where it becomes very difficult to invest, because as things are going up, we want to keep buying things that are going up because that makes us feel good. The hard thing to do is to buy things that are going down, because those don't make us feel good. But that's the emotional issue of what happens in markets. And that was and again, this is the entirety of the discussion in this past weekend's newsletter, which is applying this art of contrarianism to your investing protocols. So as you start looking at assets, start looking at where opportunities are to reduce risk and where there are opportunities to add risk, because this market will rotate eventually. But again, it's you can't say when, you don't know when. It can last a lot longer. These bifurcations in markets can last a lot longer than you think, but eventually you get a transition in the markets and a rotation. And then, this, like for instance, the dollar's getting sold off now. That will change. And we're going to have just like we did before in October of 2022, we were kind of having these same conversations. Dollar's getting sold off. It was all of the articles about de-dollarization, and Mike and I were writing articles saying, hey, that's not the case. And then we had this super strong rally in the dollar. It was just simply the dollar had gotten extremely beaten up, and then you had people put money back into it. And that's all that's occurring now. Now, is the dollar done going down? Not right now. It's got more downward pressure. It has a lot of negative momentum. That's going to have to exhaust itself at some point, and it will. And then you'll start getting a reversal. And as you start getting reversal, all the shorts that are in the dollar, for instance, have to start to cover. As they have to cover their short positions, that forces the dollar to go higher. And then you get this reversal trade in the markets. So again, just be cautious. And this is one of the conversations I had with Adam over the weekend. This is the hardest one for people to grasp, is to be careful of your rationalizations. Everybody's trying to rationalize why stocks are doing what they're doing, or why gold is doing what it's doing, or why Bitcoin is doing what it's doing. Oh, there's a reason for this. The reason this is happening, and it's not. That's just us trying to understand, or trying to apply some rationalization to the chaos of what's going on in the markets. But those really don't have anything to do with what's happening. It's simply you've got buyers on one side, you've got sellers on the other, and that's moving the price. And at every point, both the buyer and the seller think they're right. And at some point, one of them is going to be proven right and one will be proven wrong. So again, this is just the thing you have to step back from and go, okay, when I'm looking at this and I own this, what's my expectation? What's my goal? And then have I achieved that goal? And if I did, where's my risk, right? Because it's all ultimately at the end of the day about managing risk. Because at some point, everything reverts to the mean. It doesn't matter what it is. It doesn't matter what the asset is. It doesn't matter what is going on within the world. The price reversion, either way, up or down, will occur. And then what we'll do is we'll change the rationalization for why that's happening, right? Stocks are going down right now because of Trump and tariffs and all those type of things. And then let's just assume that nothing changes on tariffs. And then the market starts to rally. Then it'll be, well, markets are rallying because of tariffs. And you'll be go, well, that doesn't make any sense, but that'll be the story. And there'll be a rationalization why stocks are going back up now because of these tariffs. And it's providing all this benefit. We're getting all this revenue, and we balance trade, and whatever the story comes out to be. But there'll be a rationalization as to why. The reality is that sellers got exhausted and buyers stepped in. And people that have that ability to be a contrarian investor will be able to buy that opportunity from sellers at much lower prices. And then they'll make money coming out of this on the other side. Same thing with every asset. So again, just, and so I encourage you to read the newsletter this weekend, because again, it just kind of goes through a lot about the art of contrarianism itself, kind of the rules to follow, regardless of what asset it is, and kind of how to navigate what potentially comes next, because the world we have today will change. It always does. And we want to make sure that we change with it as we're kind of going forward and managing and mitigating that risk as we go along. So that's going to bring us to our conversation when we come back from the break, talking about the 200-day, 50-day moving average crossover. And, this has been an article that's, been all over the media over the weekend. I can't tell you how many articles that were either sent to me or that I saw in various forums about the death cross. The death cross is back in the markets, and so I wrote an article. It's on the website this morning, kind of going through the history of the 50, 200-day moving average crossover. So when we come back from the break, we'll kind of go through that. We'll touch on those different kind of historical, times, and when the death cross mattered and when it doesn't matter. And that's the important thing to differentiate when you get into your portfolio strategy and your risk management, is to understand the differences between when it did matter and when it didn't. Come back after the break. We'll get into that. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Get ready for our next open chat edition of Candid Coffee with Richard Rosso and Michael Leibowitz, Saturday, May 3rd. Anything you want to know, we'll try to find the answer.
How do I deal with all this volatility?
Is now the time to buy bonds?
Has Danny been working out?
Register now and submit your probing question for Rich and Michael at realinvestmentadvice.com.
What's going to happen to Social Security?
Well,
the tariffs go away?
Where does Richard get his snappy jackets?
The open chat edition of Candid Coffee with Leibowitz and Rosso. Register at realinvestmentadvice.com.
Is that your bathrobe?
Realinvestmentadvice.com.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interests first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN. Or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Can we get to really big news today? Important news. Today is 110th anniversary of Oreos.
Oh, man.
They are celebrating it with a new Oreo cookie flavor called chocolate confetti cake.
Chocolate confetti cake.
Yeah, so 110 years. That just makes your whole day better. Doesn't matter how bad things are, eat an Oreo.
The Real Investment Show podcast.
When's the last time you had an Oreo?
1911.
At realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors' online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell reports, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Oh, and welcome back to the show this morning now that my mic's on. Good morning. My wife wishes she had a mute button. So my wife traveled all of last week, and she's left for the airport again this morning at about 4:15, and she's traveling all this week. And anyway, she came home from her trip, and she's been very sick all weekend. And my wife is not a great patient. You know, if I ask her, it's like, honey, is there something I can get for you? You know, like, leave me alone. Okay, just I'll leave you alone. You just be you. Die there in misery. But anyway, so she got up this morning and she left. So I get a break for a few days while she's cranky and sick. So, but yeah, that was my life over the weekend. Anyway. So talking about this death cross, this is kind of the big stories of late. It's kind of in a lot of headlines, and it's kind of been everywhere. And again, you know, it certainly sounds very ominous. And again, I'm going to run through a couple of charts with you this morning. But if you're driving your car, listening to the radio show, we certainly appreciate you. But don't try to watch and drive. Go to the website, realinvestmentadvice.com. It's also on a Substack this morning as well. It's at Lance Roberts at Substack. So again, it's in both places for you. But I've got all the charts to kind of go through the analysis and why things happen when you have a death cross. that a lot of investors tend to misinterpret. And, one of those issues is that, again, it sounds very ominous, right? It's the death cross. That certainly means, if you're saying it's a death cross, that certainly means there's big, it's a big correction in the markets and you've got a lot more to go. And now you're in this big bear market. And that's not always the case. In fact, going back to 1950, if you take a look at just averages of performance after a death cross, over the next month, stocks tend to be down. But over the next 3, 6, and 12 months, stocks tend to be higher by the time the death cross occurs. And that's an important point, because in order to get, again, this goes for every asset class. Again, by the way, it's not just stocks. This is same for bonds, same for the dollar, same for gold, same for Bitcoin, everything else. By the time that a death cross occurs, the asset will have fallen in price by a large degree, because you're having to lower 50 days worth of price. The average price of the last 50 days, you have to deteriorate that enough to cross below the average price of the last 200 days. So by the time that you can get that to occur, particularly when you have very large deviations, as we did and do, on those moving averages, it takes a long time to get there. So in order to get to that point, you've got to have a bigger correction in the markets, and you have to get to a really oversold condition. You've got to exhaust sellers to get that to occur. And so this is always one of the big things. If you're looking at an asset, whatever it is, and if you have a big gap between the 50 and the 200-day moving average, that spread between those two is very, very large. That's a warning sign, because eventually those are going to have to reverse. And when they eventually reverse, that's going to lead to a very large decline in price to get that to revert. And remember, the important thing about moving averages is they're an average for the reason. That means that over the last 50 or 200 days, the price has been both above and below those prices. And this is why deviations from moving averages are so important. Because if you have a price that is very deviated above or below a moving average, you've typically reached an extreme level where you're going to see buyers or sellers show up. So again, whatever asset class you want to look at, take a look at that asset and look at its deviation from its long-term moving average. So say the 200-day moving average. If that deviation is very, very large to the upside, it's probably a good time to take some profits. If it's very, very large to the downsides, might be a good time to start looking at buying something. But that's just the way markets work over time. These moving averages are like gravity, and it just eventually prices are going to revert back to the moving average over time. But that's why when you look at these 50, 200-day moving average crossovers, yes, they do provide a lot of overhead resistance. So it provides a cap temporarily on market rallies because they run into that resistance level. And you're going to run through some consolidation correctional processes. But over time, because you've already wrung out a lot of sellers, markets tend to be higher from that period when that cross occurred in the future. So just important. And so when we start talking about, where we are currently, and as we've showed here over the last couple of weeks, if you take a look at bullish and bearish sentiment, it's just about as negative as it can get. I mean, in fact, you've got levels of bearishness now as low as it was in 2022 and really back even in 2008. So even though we've only had this decline in the market so far, it has gotten, I'm going to go to the next chart, Brent. It has gotten very, very oversold on a variety of bases, both sentiment-wise, and this chart combines sentiment and the volatility index. And it's also at levels that are historically low, more relative to what we saw in 2022, what we saw in 2020 during that decline. Those very negative biases to the markets tend to be near market lows, not the beginning of more protracted bear market cycles. And so this goes back to why we want to be careful about paying attention to media explanations. Well, why is the market declining? Well, it's a death cross, and that means this or that or the other thing. Yes, it is certainly concerning. It is certainly something worth paying attention to. And it is something that we need to be, we do need to follow, because it does provide resistance in the short term because you have that downward pressure on the markets. But also remember, there's the opposite of that, which is the golden cross, which is when those moving averages cross back above each other. That's positive. That's bullish. And so that means that buyers are way outpacing sellers and prices are going to rise. But let's talk about the differences between when death crosses matter and when they don't matter. The death cross mattered in 2008, and you were in a protracted bear market for quite some time because of the financial crisis. The death cross mattered in 2000 when you had the dot-com crisis. You had WorldCom blow up, you had Enron go bankrupt, etc. And you were in a protracted bear market for quite some time. So there are times when the death cross is something worth really paying attention to. Then there's times where the death cross occurs and it marked the bottom for stocks. And those were at times like 2010 when QE1 ended, or in 2012 when you had the Euro crisis, or 2015 when you had the Brexit. Those were event-driven scenarios, short-term events that were quickly absorbed by the markets, and then markets kind of resumed back on their tracks. But there was no financial crisis. There was no credit-related event. Nothing like that was going on behind the markets that led to a more protracted reversion in economic outlooks. And so what this chart shows you is the time. So the gold shaded areas are when you have a golden cross, right? The 50-day is above the 200-day. The red shaded areas are when you have a death cross. And what you'll notice is that death crosses, more often than not, are typically fairly short-lived, unless you're in a structural decline within the markets. There's a structural event behind the markets, like the dot-com crisis. You had companies blowing up. There was all of a sudden the whole thesis behind .com, the whole internet was kind of evaporated, and all the outlooks for earnings were drastically slashed to a large degree, and companies were going out of business left and right. Financial crisis, you had the whole issue with Lehman, the banks, the concerns about creditworthiness of the financial institution itself was weighing on markets. And so that makes it really hard to price what the value of the market is. Outside of that, issues like going into Iraq, or just having a correction in the markets, or the end of QE1 to QE2, which were reversed because the Fed stepped in. You had Brexit, which was over fairly quickly because the Euro environment, or are we in an event-driven environment? Well, we're in an event-driven environment right now. Earnings estimates are actually being raised going into 2026, believe it or not. Estimates for 2025 are coming down a little, but they're not being drastically slashed at this point, as if there's some economic recession on the horizon. And tariffs will be resolved one way or the other. Either the markets will adapt to them, or there'll be some resolution to tariffs, and then the markets will move on to the next story. But right now, we don't have a credit-related structural event that would suggest that this death cross is something that's going to be more protracted, like we saw in 2000 or in 2008. All right, we'll come back in a minute. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Get ready for our next open chat edition of Candid Coffee with Richard Rosso and Michael Leibowitz, Saturday, May 3rd. Anything you want to know, we'll try to find the answer.
How do I deal with all this volatility?
Is now the time to buy bonds?
Has Danny been working out?
Register now and submit your probing question for Rich and Michael at realinvestmentadvice.com.
What's going to happen to Social Security?
Will the tariffs go away?
Where does Richard get his snappy jackets?
The open chat edition of Candid Coffee with Leibowitz and Rosso. Register at realinvestmentadvice.com.
Is that your bathrobe?
RealInvestmentAdvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
Attention Chevron employees and anyone else receiving or considering a company severance package. We know the process can be intimidating. What should you know to maximize your payout? Lump sum or pension annuity, retirement plan rollover or not? What about tax timing your severance? The fiduciary advisors at RIA Advisors can help you make the best decisions for your situation. Call us today at 855-742-7526. That's 855-742-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So I'm anxious to see how this is going to look. We have no lights in the studio right now, so when the camera, when you see kind of what's going on in the studio right now, it's just completely pitch. Got to say that careful what letter you stick in front of that one. It's completely pitch black in the studio right now, so this is going to be interesting to kind of finish up the show with. Apparently, we had a lightning strike outside because it's kind of rainy outside at this moment, and there was this huge thunderous boom, and then all the power went out in the building. So we're running a battery backup at the moment. So it sounds like a heart monitor in here. You'll hear these little beeps. That's just our battery backup at work. So yes, it's the Halloween edition, as our chat says at this point. Yes, Brent is correct. This is the death cross right here. So just to finish that conversation up, sorry there was a glitch in the broadcast too. When the power went out, we had to switch over to battery backup. So a little bit of the conversation got blown up. But one of the things that, again, when we're talking about the difference between a structural event and a structural environment with the death cross, which leads to more protracted declines, when you have event-driven markets, those tend to be much shorter lived, generally a couple of months, 3 months, 4 months, 5 months, and then they're over with, and then markets are back to their narrative. One of the defining points of that is how your sentiment and your positioning in those environments. And right now, again, as I was showing you earlier, if you take a look at the technical oversold conditions, you take a look at the sentiment conditions of investors, they're so incredibly bearish that this is really the opportunity to start looking for assets that are selling at very deep discounts, selling assets that are very, very overbought. But see, that's the hard part to do. We start rationalizing, as we were talking about earlier, this is where we start rationalizing why this asset's going to continue to go up forever at this point. It's just going to keep rising. There's no reason it's not going to keep going up because of all these reasons we've assigned to it, and we ignore the deep oversold conditions that exist in other assets. And so we miss those opportunities to rotate that within our portfolios. And again, one of the mistakes that when I talk about things like this, one of the mistakes that people think is like, oh, well, he's saying sell everything. And that's not the case at all. It's just that, as we often talk about with stocks, take profits, rebalance risk, et cetera. It's the same thing with any other asset as well, Bitcoin, whatever it is. And so just that process of rebalancing risk, looking for opportunities, putting capital to work at discounted prices, that's how you build long-term wealth. But that's also a very challenging environment to be in
because again, you're having to do stuff that really kind of goes against the core of your psychology. It's like, well, why would I sell this? It's going up, right? Or why would I buy that? It's still going down. But that's the hard part about investing. That's the contrarian nature of being a good investor. And an article I've got coming out on Friday is I went back and I've taken some investment rules from 10 legendary investors over time. And when you look at how they manage risk or manage their portfolios and what made them so successful, whether it's Howard Marks or Jeff Gundlach or any of these guys, what made them so successful was not about trying to buy or sell right at the top or the bottom. It was about managing risk. It was just always about focusing on the risk allocation they took in portfolios. And what happens for most investors is they get too emboldened into whatever's working and they wind up taking on too much risk. And they start overweighting assets that are going up, underweighting assets that are going down, and that in the middle of the decline, that's good, that works. Or in the middle of the advance, that works very well. But when you get to extremes, that's when you have to really start making the hard choices to rebalance risk. And that's the tough thing to do, because again, we all want to rationalize why we're right. And that becomes the real challenge of what's right in reality versus what we think is right in the short term. Okay, enough of that. Articles on the website about the 200-day moving average crossover. It's called the death cross and market outcomes. I go through all the data for you, give you some kind